Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. Seems like just the older I get, seems like things get just a little harder. Maybe it's just me, but no, there's so many options out there today. I have a database that actually I have two databases. One of them covers individual stocks and exchange-traded funds, and the one from Morningstar covers everything. I mean, it's really expensive, and those dogs raised my fees this past month. I spend a lot of money just on data, and but it's very useful. I like to use it to figure out retirement income plans for people and how much you need. And I was just laughing about this with a couple clients over the past week. We've been using a 4% rule. It's kind of common. You can look it up. And basically what it says is that you should don't start out taking more than 4% of whatever your savings are for retirement. So if you have, just to keep my math easy, if you have $1 million, you shouldn't spend more than $40,000 that first year, because over time you're going to have to increase that each year for inflation. So in 20 years from now, even at a 4% inflation rate, it's right around 20 years, give or take a year or two, the amount of money that you have to take out is going to be double. So at that point in time, you'll be taking out 8% of what you originally started with. And that's why the first number, the 4%, is so low, because when you adjust for inflation every year, or every other year, or once every 5 years, that's what a lot of people do. They go there for that first 5 years, and they don't make any adjustments, and then they go, well, okay, I might have to make an adjustment now. And that happens quite often. And incidentally, what's really interesting is that first 5 or 10 years of retirement, your income, you tend to spend a lot more than you do after that point in time. So that's another thing to keep in mind. It's not a straight line. If you look at the inflation rates, and if you look at how much money people need to spend, and then there's an awful large element of luck involved, because if you end up getting sick at a younger age, you end up spending a lot of money, and you just have to try to plan for those things the best you can. Just take your best guesstimates and figure that with your investment returns, I always figure those kind of low. And in an average balance fund, you look at over the past 4 or 5 years, not really good. I've got a moderate allocation fund from BlackRock. I looked at the balanced fund from Vanguard and Fidelity, and over the past 4 or 5 years, it's pretty much the same thing. You see a whole lot of up and down, and more up and down than going up. And Fidelity's Balance Fund is actually one of the better performers. It just took out its all-time high, but there was from 2021 all the way up to recently. That's 3 years. 3 years, and all you got was a lot of volatility, and now you're barely. And this is one of the better performers, mind you. Actually, this is one of the best performers. And so one of the reasons I like to use exchange-traded funds and try to build the models that I think are going to do better over time. And I can tell you for sure that we've got to do a seminar one of these. I think in the next 2 months. We're trying to time it up. I don't want anybody to get sick, and all the facilities. I think they're back to letting us have normal meetings now, but for the longest time there, you had to stay 5 or 6 feet apart, and they just weren't accepting a lot of general meetings like that. So we'll try to get a seminar going here because it's pretty important. Markets are always changing. Markets are always evolving, and to generate enough income to support yourself in retirement is pretty difficult. And a lot of that income is going to come from growth. It's not necessarily a dividend. And incidentally, this is one of the things that over the next 5 years, the numbers should be significantly improved because a large portion of the assets are in bonds for most retirees. And bonds have had the worst 3 or 4 year time period they've had in 40 or 50 years. So assuming that doesn't happen again, knock on wood, I doubt it. I mean, if interest rates were to go back down, bond prices would shoot back up. It's like a seesaw. Interest rates on one side, the bond price on the other side. One goes up, the other goes down. So if interest rates were to go down again, the bond prices, they would make up a lot of the losses that they've incurred over the past 2 or 3 years. And it's very confounding for an awful lot of people. And I always knew it could happen. I was just kind of hoping it would, if it came, it went really fast. But unfortunately, that's not how it came. That's not how it worked out. It's been a long, slow process and painful. I mean, I'm watching it all the time and closer than most people are. In fact, that's one of the reasons I want to get back and do some seminars in person, because this is people are wondering. They're looking at it and they don't have the information I have. So they're like, why is this not keeping up with the stock market? Well, because you got 40% of your money in bonds, and bonds have been doing poorly. And it's an unusual time in the country's history where this has happened. It happened in the 70s, happened a little bit in the 80s, and then for the 2000s, bond prices were pretty steady. The yields were pretty steady. And then you get fast forward to 2020, and not so much. So, and the distance between those good periods and bad periods is different. I mean, there's no cycle. You can't see it coming. You can kind of tell a little bit about what's happening if you project that into the future. If you project whatever's happening right now into the future, but at some point in time, it's going to change again. So what's the smartest thing to do? Well, I've been holding on to bond funds that have super short maturities, but they still got hit. They just didn't get hit quite as hard. And they made back up. They've made back the amount of money that they've lost. If you reinvested the dividend, the share price from where it was at its peak is not down a ton. Let's see what that is. 1.96. Okay, so, and the yield on it's over 5% right now. So, yeah, that does make a big difference. And it's if you've got that type of bond fund in your portfolio, if you have access to it, and this is one of the reasons that when you have a 401k and it's with a big company and you like it, you still won't have these types of options available, generally speaking. At least I haven't seen one, and I look at an awful lot of them. But and that's one of the reasons to maybe have a portion of your money, even if you love your 401k, and I've seen some pretty good ones out there. I've had conversations with people where um, constantly I'm looking at it, I'm going, wow, you know what? We should probably leave a certain amount there because you have access to this fund, and that fund is an institutional fund. It's not available outside of 401k plans, so that might be a good idea for us. And and if not, there are lots of funds that are extremely similar. That's another thing about today. You look at the number of funds that exist relative to the number of stocks that they have to invest in, and it's mind-boggling. I mean, there are 4 or 5 funds for every investable stock that's available. That's I, I had no idea that was going to happen. That all these companies are not striving to go public the way they did, 10, 15, 20 years ago. Going public is a great way, if you've got a good company, to be able to take cash in a little bit on the investments that you've made of your time, money, effort, and energy, and allows other people to invest and grow alongside you. And it's just not happening like it used to. It's very, very slow. And a lot of the ones that do come public are really, nothing to write home about. It's been an incredibly long time since you've had a Google out there. And hopefully it happens. I see a lot of growth in the economy, and there are tons of areas inside that have to do with electricity. Let me put it that way. Generation of electricity, distribution of electricity, products that run on electricity that used to run on natural gas or gas, as far as cars go. And natural gas or other products, by the way. But so nothing is as constant as change, and the change is actually incredibly fast. A lot of it's behind the scenes. It's not something that you would notice, like when PCs first started coming out and people first started buying them. Well, you could see that, and most people were trying to get one. Now, PC, average household probably has 2 or 3 at least. Don't get started on cell phones. I think the average house probably has somewhere around 2 or 3, just because spouses typically have one. If they have a child, by the time that child's going to school, they have one, and that's not going to slow down anytime soon. In fact, they'll change. They'll be able to do more stuff. I'm always flabbergasted when I see what you can do. In fact, I'm doing my show through my cell phone connection to the radio station. But you can still call me, 216-901-0945, 216-901-0945. And we're going to have to go to a commercial break in a couple minutes. But you can always give us a call, and I'll be glad to try to answer any questions you have. And by the way, one of the reasons that I talk about retirement income planning is it is such a monumental task to be able to set aside enough money to be able to retire and replace, even 70 or 80% of your income. I'm not talking about, having more income or, having 80 to 90% of your income. I'm talking about 75 to 80% of your income. That is a monumental task to get enough money together in your savings to be able to do that. Well, why? Because there's a lot of competition for your money, and they don't really talk about this a lot. And I really think that they should start teaching this stuff to kids when they're in the 5th and 6th grade. I don't know if you have any grandchildren who are around that age. I do. And I'm telling you, these kids today are way smarter than we were. at least me and my friends. And that might say a lot about me and my friends, by the way, but that's another story. Anyway, the kids are extremely bright, and they could get this stuff. They could understand. I know I would have understood. I had a paper route around then. So I had to go collect, and I had to pay for the papers that I was delivering, and when somebody stiffed me, I delivered papers to an apartment complex, and it was fairly big, so that was my only those were my only customers, and there were about 60 of them, and some of those people would not pay for 3 or 4 weeks before they moved, and then they would move. So I got to experience what it's like to be a real business owner. Because I'm delivering that paper every day, and then looking out the peak hole and see me out there collecting and not answering because they knew they were moving. What kind of person does that to a 12-year-old kid? Anyway, but it was a good experience. I mean, I learned a lot. I learned a lot about business. I was literally responsible for the papers that I was delivering. I had to pay for them. And now it was actually the Cleveland Plain Dealer. And they would tell me what to charge. So they set the pricing on it. And then they had a price that I had to pay. And my pay was the difference. So when somebody moved out, I didn't, the Cleveland Plain Dealer still had to be paid. They didn't let me off the hook for that. And, a lot of people thought that was a little over the top, but I've got about 60 seconds here, so I'm going to have to finish this thought after these commercial messages. This is Bill Bullington right here on 1420 every Saturday morning from 11 to noon. Stay tuned because we will be right back.
I'm losing sight of all that matters.
This is Dennis Prager, and now a truly exciting new benefit. My monthly online video get-together for Pragertopia Plus members only. For an hour each month, get an exclusive chance to ask me anything. I'll be answering your questions. I've never done this. Submit your questions for me at Pragertopia.com. This is our chance to connect like never before. Go to Pragertopia.com or click the banner at DennisPrager.com.
Everyone wants to know what's going to change.
What can we expect in the future?
Heck, I want to know too.
But in plumbing, the important stuff is what's not going to change.
People are always going to want their call answered by a real human who can help them.
And they're always going to want an honest, do-it-right plumber to fix the problem Wallacadoodle style.
And they're always going to want that to happen today, not tomorrow.
So at Wyatt Works, that's what we focus on.
That's why we're introducing same-day water heater replacement.
Because let's face it, no one wants to take a cold shower the morning after they discover a broken water heater.
Well, maybe some health nut who likes cold plunging. But most of us want that hot water.
So when you call Wyatt Works for a broken water heater,
we'll get your replacement installed and installed right that same day.
We'll even Wallacadoodle it by taking away your old one and clean it up like we've never been there.
Just call Wyatt Works and
consider it done.
You've heard the saying, all good things come to an end. Well, not always. Sometimes they just take a break. That's what's happening with Our Lady of the Wayside's car donation program. After 24 years and 96,000 rides donated. Pretty amazing. Here's the story. The car lot's owners sold the property, making it impossible for car donations to be accepted at this time. According to the Wayside CEO, Terry Davis, the next right steps will be determined and communicated soon, so stay tuned. In the meantime, Terry and the entire team at the Wayside thank you for your continued support of the 450 individuals with developmental disabilities in the Wayside's care. And please take note, you can still support them by making a donation at thewayside.org. Is it finally time to update your bathroom? Bath Planet, a division of Joyce Factory Direct, specializes in replacing and converting old showers and tubs into new, beautiful bathrooms in as little as one day. We have transformed thousands of bathrooms just like yours into a spa-like oasis that has homeowners excited to use their new bathtub or shower. Right now, all bath installations are 50% off. So call to schedule a free consultation with on-the-spot pricing. 440-243-5700 or visit JoyceFactoryDirect.com.
I got a story.
And we're back. Something to be thankful for? Oh, yeah, we were just talking about fixed income and how it's surprising that fixed income, that's normally the portion of your account that gives balance and keeps your portfolio from dropping too much. But when you look at the aggregate bond indexes out there, Vanguard's got a fund that basically it's kind of like the I don't know what you would call it. It's kind of like the S&P 500 is to the stock market. Very difficult to beat in the long run, and it's down 20% from where it was in 2020. I don't know if you've looked at the calendar lately. It's 2024. So that is mind-boggling. I never thought you would see that. I literally did not expect that to happen. I expected the drop to occur, but I thought it would be over sooner than that. This is like Chinese water torture. Every time you think you're getting a break, it stops going down and starts going up again. It turns around and goes down even lower. And it's just mind-boggling how long that has persisted. And when people are upset over their investments, it's typically because they've got a lot of bonds in it. And who has a lot of bonds in their portfolio? Almost every retiree, or somebody who's getting close to retirement, or somebody who just has a moderate growth, or a moderate risk tolerance. So that's been where they've been able to turn. That's one of the reasons that I'm looking at a lot of the accounts. People are still upset because if you're withdrawing, even though this one from Fidelity, they call it a low duration bond factor. And low duration is kind of a measure of how a bond fund moves relative to other bonds. It's pretty complicated, but the higher the duration, the more it's going to fluctuate. So the lower the duration, the less it fluctuates, theoretically. But when you put bonds in a fund, with the regular bond, Treasury or government, Treasury, which is a government bond, at least one type of government bond, or a high quality corporate bond, so you got AAA, let's say they're all relatively short term, which means they're somewhere between 2 and 4 years. Okay. That's considered relatively short term. 2 years, you go out 6 months. I mean, you can buy a bond that matures in a month, but typically it's pretty aggravating to do that in your portfolio because you're spending an awful lot of time. Get maybe, I don't know, a couple hundredths of a percent or so. Not a super effective use of your time, but which is one of the reasons I like this fund because it's actually relatively new and it's gone through some of the harder times in the market. And if I draw a line right through the middle of the price performance, it's right where it was back in 2019. So that's pretty good. It did have a big dip when the pandemic came in because putting bonds into a fund like that, it turns it into a stock actually. It's just not, it doesn't fluctuate as much as stock funds do. Bond funds typically don't. It depends on the type of bond fund, by the way. And this one hasn't fluctuated nearly as much. It's been less than half. And that was during the emergency time that it fell about a little less than half of what the stock market did. And now it's back up to very close to where it was when the fund first came out. And the yield on it right now is a little over 5%. So if you want more information on anything you hear that I'm talking about, you can always call me. 330-664-0700 or go to my website at bullingtoncapital.com. And this is almost as good as a lot of the, this is one of the reasons I've been doing the fixed index annuities. I bought one, I don't know, probably 3 or 4 years ago. And, that's the last one that I purchased. I got more than one. But the last one I purchased, I was very happy, and I'm still happy that I have it because they are different than government bonds. They're different than corporate bonds. They basically give you a schedule and say, okay, if you take the income at this date, here's what you're going to get. If you take it if you wait another year, here's what you get. And it typically goes up because, quite frankly, with an annuity, your life expectancy comes into play. And the older you get, the shorter the life expectancy is, so they can afford to pay out a higher rate of return. And that's pretty good. I really like where the rates are right now. I mean, they've gone up over time, but that's okay. I still like where they are, and even when I got mine are still paying. My payment's going to be significantly higher than treasuries or CDs are, so that's good. And they're also guaranteed to pay out that income for the rest of my life. That's assuming that Nationwide's still around when I pass away. They've been around a long, long time, and they're very highly rated. And one of the things I like, what I look for in this space in particular, is that the insurance company that you're buying an annuity from is not just a life and annuity-based business, that they have other lines of business. And it's one of the reasons I like the Nationwide product so well. Nationwide's got a ton of other divisions, and all the divisions contribute to the company's general account. And so if they have to pay out some extra in the life business because people are living longer than they thought they were going to, they've got all those other businesses contributing to the company's bottom line that they can use the money from. And that's kind of a big deal. I can tell you there are companies that focused just on life and annuity business, and some of them went away, I think especially around 2008. Now, when an insurance company goes away, it's not like you get nothing the way, if you were over the limit for SIPC or FDIC coverage at a particular bank, just because you didn't want to have a bunch of accounts, you could lose money there and easily go over that limit, and you're on your own. With insurance companies, they also have guarantees, but the guarantees are typically only as good as the company or the association in that particular state. Every state's got an association that tries to make it holds the insurance companies accountable. By the way, they don't want to see anybody going belly up, so they go and inspect their books every year, make sure they're not trying to. They try to make sure that they're not taking too much risk. But when you have an event like 2008 that comes along, some of them actually went away. But what happens is the regulators come in and they literally take bids for the business. Other insurance companies, and this is, by the way, this is just one of the scenarios. So other insurance companies can come in and bid on the business. They will buy that business from the insurance company and make those shareholders whole. Sometimes they're not made whole. Sometimes they have to take a loss because, those are your choices. You can either go with this insurance company and they'll give you X percentage. And I think the lowest was around 85%, which is the lowest, which is a lot better than losing 100%. A lot better than putting your money in an S&P 500 fund and watch it drop 50%. So yeah, there's a lot of protection there, and you still want to pay attention to the company. Look at their credit ratings. I mean, there's an insurance company. You have S&P does ratings now. Moody's does ratings, and I would stick with the ones that are in the highest, 20% of their industries if you're looking around for that. So if you get any questions on that, just give me a call. If you want to see, I can send you a link too. Been sending it out fairly frequently. It will give you an estimate of how much you could expect to withdraw off of your annuities in retirement. So that's a pretty good idea, I think, getting familiar with that. And it's actually the tool I use when people come in the office. We'll sit down and pull up their ages, their spouse's ages, if they have one. If they don't, that's okay. And everybody's a little bit different, by the way. But you can, within 2 to 3 minutes, you can see how much income you can generate and what the benefits are to postponing it. And there are lots of benefits. I could take mine now, but I'm not going to. I'm going to wait until 67, and I'm full Social Security age, in between Social Security and the amount of money I get from that, that covers all my living expenses. So that's a good feeling to know that I don't have to worry about that. And then the rest of my money is just for whatever I want to spend it on. And what's nice about that is if the market does take a big drop, I don't have to touch it. That's kind of a big deal. And if you don't have to touch the money that you have in the stock market, that's where you want to be. You want to have enough money in fixed income to be able to pay your basic bills, and then the remaining money, if there is money there, you're going to put that away, and we'll buy some growth-oriented, exchange-traded funds. And I'm going to be explicit here and say growth-oriented. I'm going to explain why in the last part of today's radio program, so after the next commercial break. But I'm going to make this is kind of a blanket recommendation. I've been doing what I do for an extremely long time. I use exchange-traded funds now instead of buying the individual stocks myself because it's a lot less expensive from a tax standpoint. If you could see what was going on inside an exchange-traded fund, the amount of movement that happens, all the rebalancing that's going on a daily basis, if those were normal mutual funds, you would be paying taxes on the income and taxable gains every year, and your 1099 would be about 70 pages. So the powers that be got together and lobbied Congress and said, "Hey, look, you think the IRS agents are busy now? Wait until you see what we start reporting. If you don't go along with this is a big deal." And they were right, and it is for their best benefit. But before exchange-traded funds existed, these laws didn't exist either. And your average, I remember people getting so upset they would get a fund that had began and ended the year right around the same area. In other words, it didn't make much money, but it would have gone up a lot during the year and then crashed, literally crashed. I'm thinking specifically of 1987, crashed. By the end of the year, it had rebounded enough to end up within a couple percentage points of where it had started. So had you fallen asleep at the beginning of 1987 and then woke up, had you fallen asleep in January and woke up in December near the end of the month or year, you'd have looked at the account value and said, "Oh, wow, that was kind of boring." But if you were awake and paying attention through that ride, I mean, it was all over the place. And so not only did everybody get extremely fearful, but at the end of the year, they got the bonus of having to pay taxes on gains that they never took. The people that held on to those stocks that were outside of an IRA, those funds rather, they got a 1099 at the end of the year. And man, I can't imagine what the people that invested in January felt like, because they got taxed on huge gains that they never saw. I mean, they never saw that. And so anyway, that's one of the things. One of the things I like about ETFs, the chances of something like that happening in most stock-oriented ETFs are extremely low. So they are very tax efficient. And normally you're only paying tax on whatever dividends they've paid. And most of your growth-oriented ETFs don't pay a whole lot of dividends. So, those companies are reinvesting their cash flow so that they can continue to grow. When they get to a larger size, or they feel like the opportunities for growth may not be as good, or that they can pay out a dividend that they can sustain, well, yeah, then they'll start to pay a dividend, and they'll look to try to grow the dividend over time as they grow the business. But they're all over the map. You've got a bunch of newer companies out there. A lot of the tech companies don't pay dividends unless it's a special dividend because they've got a whole bunch of money saved up that now they don't know what to do with it. So they decide that, I'm just going to pay out a special dividend. And that's nice. But if it's a special dividend, that means it doesn't have to repeat. So there's a lot to think about. I mean, it's on the surface, everything seems so easy. And then the devil is definitely in the details. Definitely. And there's so many items that you could potentially talk about. And but it's like almost anything else that you do in life that's worthwhile and challenging, whether it's building a career, building a business, building a marriage. I mean, you're gonna work hard, and a lot of times hard work is going to seem like it's just getting it in deeper, and it's not being effective. But you can't lose confidence. You got to keep going and talk to yourself. One of the reasons I have a job, and I'm telling you, it's not an easy job. The markets scare people, and I'll tell you this: as long as they keep printing money, this is how the game works. You're going to have inflation, and as long as the inflation is caused by companies who are raising prices. Why are they raising prices? Because they're trying to maintain their profit margin. If you're in business, to make profit. If you don't make profits, you're not going to be in business very long. So it's just the kind of the way things all work together, and it's actually pretty cool. I've only got a few seconds before I have to take a real quick commercial break. So this is Bill Bullington. If you have questions for me, please go to my website, it's bullingtoncapital.com. Reach out to us there, or just call us, 330-664-0700. That number again, 330-664-0700. And I'll be back right after these messages.
Is the door to peace? Sometimes heartache is the gift I need. You're faithful in all things.
Everyone wants to know what's going to change.
What can we expect in the future?
Heck, I want to know too.
But in plumbing, the important stuff is what's not going to change.
People are always going to want their call answered by a real human who can help them.
And they're always going to want an honest, do-it-right plumber to fix the problem Wallacadoodle style.
And they're always going to want that to happen today, not tomorrow.
So at Wyatt Works, that's what we focus on.
That's why we're introducing same-day water heater replacement.
Because let's face it, no one wants to take a cold shower the morning after they discover a broken water heater.
Well, maybe some health nut who likes cold plunging. But most of us want that hot water.
So when you call Wyatt Works for a broken water heater,
we'll get your replacement installed and installed right that same day.
We'll even Wallacadoodle it by taking away your old one and clean it up like we've never been there.
Just call Wyatt Works and
consider it done.
Do you ever find yourself saying, I need a vacation? Vacation Fixation can help. At Vacation Fixation, we specialize in all-inclusive trips and cruises to Mexico, the Caribbean, and Disney vacations. Why choose us? Our clients book through Vacation Fixation because they are frustrated with online trip brokers and timeshare scams. Whether it's a weekend getaway, a family trip, spring break, or honeymoon, Vacation Fixation will personalize a trip just for you. Want to know the hottest destinations in Cancun, Punta Cana, Jamaica, or Puerto Vallarta? Interested in room upgrades, beach reviews, or details about resort restaurants? How about finding a trip with a direct flight? At Vacation Fixation, we take all of your specific travel requests and shop our suppliers to find the best deal. What's the cost? Our suppliers pay us so you don't have to. Call 330-573-8147 for more details. Or you can visit our website at vacationfixation.com or check out the deal of the day on Facebook. Vacation Fixation.
Thinking about updating your home? Well, Joyce Factory Direct specializes in replacing old, outdated windows. Proudly made right here in Cleveland, Joyce Windows features their exclusive Smart Shield high-performance glass, which means you'll be getting the most energy-efficient windows for your home directly from the factory. Customers just love how much warmer their house is and how easy their new windows operate and clean. Right now, you can save 50% on all installations. Just call to schedule a free consultation with on-the-spot pricing, 440-243-5700, or visit JoyceFactoryDirect.com.
Well, welcome back. This is Bill Bullington. I'm here every Saturday morning from 11 to noon. If you'd like to send me a question online, you can go to my website, bullingtoncapital.com. Also, just email me, bill@bullington.com, or you can call us 330-664-0700. We will try to get back to you as quickly as humanly possible. Hey, have you guys noticed? To me, it's kind of amazing. I mean, ever since the pandemic, and it may not have a lot to do with the pandemic. I think there are other factors. I know there are. There are other factors at work here. But online, it's been becoming much more complicated and much more difficult to set up accounts and get account access. And that's kind of, it's been rough. We spend probably 2/3 of our time now on trying to help clients get their get access with accounts that aren't held at our firm, which is they're clients. What are you going to do? And a lot of my clients are older. That's just the fact of the business. The average person, average young people really don't have a ton of money saved yet. So it's the above average, like well above average young people that do have substantial savings and want to know what to do with it. But so our demographic looks very similar to the industry itself. Average age is older, and they don't have the kind of time it takes to be fooling around with all this stuff online. And I get it. You know, I'm always having to do things myself, and I'm looking at me. I would die if I had a normal job where this wasn't what I did, or at least wasn't part of what I did for a living. It would drive me crazy. And so I feel bad for you out there. And that's one of the reasons, we use Fidelity as a primary custodian. We had got an Axos that used to be E-Trade, and E-Trade sold this division to Axos. They're the world's biggest online bank. Fidelity's a little easier, by the way. They're a little easier to deal with for me. They are. Not so much for Gary. He's got to do all the trading. And it's pretty manual there. So that's why I have a person dedicated just to do that. So, and then we've got Melissa in my office. If you've ever called in, you've probably talked to her. She is one of the best admins I've ever worked with in my entire career. So fast and efficient. And then there's myself, and I'm in looking at reviews, helping people set up strategies, try to help them reach their goals the best we can. And just looking, there are a lot of things. There's a lot of, what do they call it, conventional wisdom. It just doesn't seem very wise to me anymore. I've known this for a long time. And, we get audited by the State of Ohio Department of Securities. They come in typically once a year, and they look at all the asset allocations, to look at how much risk somebody wanted to take. Does it match up? Are you doing something you shouldn't be doing there? I can't believe anybody would do that, by the way. I mean, to do something wrong in my industry, it's a matter of time. You're going to get caught. It's not if, it's when. We have to document this stuff, and the vendors have to document this stuff. You would be a fool to try to get away with something. And by the way, evidently there are a lot of fools, because I get letters from our compliance people, and they show what people are trying to do around the country, and the SEC coming in and busting these guys. And I'm just like, really? I mean, I can't believe. Despite the fact that I like to think I'm a nice guy and I would do the right thing anyway, that's my goal in life, is at the end of my career, I can look back and say, you know what? I did my very best. I did the best I could for each and every one of these people. And but even if that weren't true, the fact that you can get whatever you do, you have to document, and it's documented so many times, you're going to get caught. I mean, it's not a matter if, it's just when. And maybe they don't get to you because you're a small firm and you're kind of old, and But you know what? Yeah, they will get to somebody. That business, that is going to go to some other firm at some point in time, and it's always there. Once it's been recorded, that's a permanent record and can be looked up. So just to make you feel better, if you're dealing with somebody who's halfway decent, and well, the decency doesn't even matter. It's intelligent. They, you're going to get caught if you do something wrong. So, just do the right thing. That's my point to this whole ramble. Do the right thing. And I just try to be the advisor that I would like to have. Just tell me what I'm up against. Don't hold back. Don't hold anything that you think I'm not going to like. You just tell me the way it is. Give me some options and let me pick. And if that's how I like to run my business. Now, I will tell you this. I get clients coming in all the time and say, well, what would you do? And, okay, I will tell you what I would do if I were in your shoes. I happen to like the long-term returns on stocks. Are they a little elevated now? Yes, they are. What does that mean? Well, you could go for 4 or 5 years and not make a whole lot of money in stocks right now. And but I'm good with that. Why? Well, because I think I'm going to live longer than 4 or 5 years from now. That's why. So my time horizon is longer than I see. Now, in the 2008 through 2009, that was pretty spooky. And I don't want to say we saw that coming because people think exactly the day, but we were within a few weeks of both the peaks and the bottoms. The bottom on 2003 was the little easier, I think, to see. That decline started in March of 2000, by the way. So, this is why this business is so tough. The beginning and end of a big move doesn't happen in a year. And most people think in 1 year increments. In fact, the people in our industry, I feel like, are guilty of leading them to believe that they need to look over 1 year increments. Why? Because they published a 1, 2, and 3 year track record. Why do you do that, you knucklehead? Let's just use a 1, 5, and a 10. I'll go 1, 5, and 10. And even that, I get it. You're going to have people that make assumptions that aren't accurate because that's what they're looking at. So you have to know, you literally have to know better than just to use the track record. What are they doing with the money? That's more important than their 1, 5, and year track record, 1, 5, and 10 year track record. And I'm going to tell you, focus on those funds that are focusing on the amount of growth that company is experiencing. What's their growth in sales? Next thing should be, okay, is that being recognized? Their sales growth being recognized. What do I mean by that? Well, how is that stock performing relative to other stocks in the index or in their in their category? So if it's a small company, how well is this performing relative to other companies that are similar in size or at least in that category? The next thing is, what is their level of profitability? Profitability is a big deal. By the way, dividend yield is one of the things that you can use. It kind of measures profitability. If they're not earning a profit, they're not paying a dividend. So actually, I take that back. Some companies would borrow money to pay a dividend to give the appearance that things are all right and that they're looking good. Another reason that you want to diversify. When you buy a fund, it's got minimally 50 stocks in it most of the time. So it's going to be diversified. Most of them have a couple hundred in there. Some of them have, more than a couple hundred. But bottom line is you're getting diversification. You're getting attributes that those companies have, like sales growth. How big is the company? How fast is it moving? Those are incredibly important aspects of what makes up a good stock going out into the future. If the company is growing and their profit margins are hanging in there, then the profits are going up. If they're paying out a dividend and they're making more money, they typically raise the dividend. Makes sense? Now you just need 3 or 4 categories, and I think you're good to go. But incidentally, I was talking a little bit earlier about being able to track your portfolio performance. You can do that. There are a lot of easy ways. One of the easiest, if you don't want to spend a lot of time setting it up and trying to set passwords and user IDs and getting rejected when you don't keep it up to date and all that stuff. What's really easy is just go look at each annual statement, and it gives you a summary at the end of the year. The annual statement gives you a summary, and it makes it so much easier. You just pull up the past 5 or 6 years. That takes about, it takes us about 10 minutes to do on an account, and at the worst. So, and then you get to see, it will summarize, did you transfer money in that year? Did you take money out that year? How much did you transfer and how much did you take out? What did you start off with? What did you end up with? And I can't tell you how many people forget that they've either transferred money in or they've transferred money out, or they had to spend something. Well, this year, there was a distribution made of this. I didn't make a distribution. Here it is. And then we'll go back right to the exact month. Oh, what was that for? Oh, yeah. Oh, now I remember. Yes. One of the reasons I really appreciate having a custodian who is not owned by Bullington Capital. Those aren't my records. Those are the custodian's records. And the custodians we are regulated pretty intensely. Those guys, man, it's why you have accounting majors in college. And I would not like that job, but I do appreciate the job that they're doing. And it just makes it so much nicer for clients because you can find the data. It's there. And these guys have gone back. They go way, far and above anything that is expected. They go far and above what, the SEC says they do. I would rank the companies. Yeah, I think Folio and E-Trade are Axos are about the same. Folio is owned by Goldman Sachs. They have to keep the same records. We can go back in and request it. Sometimes they charge us for it if it passed the amount that they're legally required to do, but that's okay. And Fidelity doesn't. And Fidelity, from a record-keeping standpoint, is probably number one. So I like it. It's a little bit harder for us to manage the money there, that's for sure. Their trading platform, they put more money in keeping the super important records than they did making our lives easier. But that's okay. It's better for the client, and I really like that. Man, I've got about 45 seconds here, and I got to go. I can't believe how fast this whole hour went. If you heard anything that you would like more information on, or you'd just like to have a conversation, feel free to drop me on a line. My email address is bill@bullingtoncapital.com, or you go to my website, which is bullingtoncapital.com. I really appreciate you listening this morning. Have a good week, everybody. Good luck, and good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.